The G-SIB trap. Why banks sold everything before December 31st, midnight. While the world was celebrating, the biggest banks in the world were executing a coordinated sell-off. Gold dumped, silver crashed, stocks liquidated. Billions of dollars vanished from the market in minutes. This wasn't panic. This wasn't a market crash. This was compliance. A single regulatory rule forces the most powerful financial institutions to strip their balance sheets clean every single year. And if you don't understand what happened, you'll be caught in the trap again. The question isn't why they sold. The question is, what are they preparing for? Welcome to Financial Announcement, where we decode the moves the institutions don't want you to understand. Now, if you've been in business for a while, if you've seen markets rise and fall, then you know the value of real information. So do me a favor and hit that subscribe button. Not because I'm asking, but because you deserve to see what's coming before it arrives. And tell me, where are you watching this from today? New York, London, Dubai, Mumbai? Drop your city in the comments. Now, let's get into the story. On December 31st, 2024, something unusual happened in the global financial markets. While most people were preparing for New Year celebrations, the world's largest banks were engaged in a very different kind of countdown. They were selling assets at an accelerated pace. Gold prices dropped sharply. Silver followed the same pattern. Stock portfolios were being liquidated across multiple exchanges. This wasn't a coincidence, and it wasn't driven by market panic. This was a regulatory requirement. Every year on December 31st at midnight, financial regulators take a snapshot of every major bank's balance sheet. This single photograph of their financial position determines how much capital they must hold in reserve for the entire following year. It determines their risk classification. And most importantly, it determines how much money they will pay in regulatory penalties. The banks know this date is coming. They prepare for it months in advance. And when the final trading day of the year arrives, they execute a strategy that has become predictable to those who understand the system. They convert everything they can into cash. The reason is simple. In the eyes of regulators, not all assets are created equal. A bank holding $1 billion in cash is seen as less risky than a bank holding $1 billion in gold, stocks, or bonds. The regulatory framework assigns different risk weights to different asset classes. Cash carries the lowest risk weight, everything else carries a higher one. This creates a powerful incentive. If a bank can show more cash and fewer volatile assets on December 31st, their regulatory burden decreases significantly. They face lower capital requirements. They avoid higher penalty brackets. In some cases, the difference can amount to billions of dollars in savings, so they sell. The technical term for this practice is window dressing. Banks temporarily adjust their portfolios to look better on paper at the moment regulators are watching. They know the snapshot is being taken at midnight. They know exactly what the regulators are measuring, and they optimize their balance sheets accordingly. But here's where the situation becomes more complex. When one major bank decides to sell assets and raise cash on December 31st, the impact on market prices might be manageable. But when 30 of the world's largest banks do the same thing simultaneously, the effect becomes dramatic. The volume of selling overwhelms the available buyers. December 31st is typically a low-volume trading day. Many institutional traders have already closed their books for the year. Liquidity in the market is thin. When massive sell orders hit a thin market, prices move violently. Gold, which had been trading steadily, suddenly faced a wave of institutional selling. Silver, which is a smaller and more volatile market, experienced even sharper declines. Stock indices showed unusual downward pressure in the final hours of trading. Bond prices fluctuated as institutions rotated out of fixed income and into cash equivalents. Retail investors, watching their screens, saw red across every asset class. Many assumed something fundamental had changed. They thought perhaps there was breaking news they had missed. Some panicked and sold their own positions, amplifying the downward pressure. But the professionals knew better. They understood this was a temporary mechanical event, not a fundamental shift in market conditions. They knew that once the regulatory snapshot was taken at midnight, the pressure would lift. The banks would no longer need to maintain elevated cash positions. Capital would begin flowing back into assets within days. This creates a predictable pattern. Prices drop artificially on December 31st due to regulatory-driven selling. Then, in the first week of January, prices often recover as banks reverse their year-end positioning. Traders who understand this pattern can anticipate the movement. Those who don't understand it get caught off guard. The phenomenon has a name in regulatory terminology. It's called the G-SIB assessment, and it affects every bank classified as globally, systemically important. These are the institutions considered too big to fail. The regulators monitor them more closely than smaller banks, and the rules they must follow create these predictable market distortions. But to truly understand what happened on December 31st, one must first understand what G-SIB actually means and why this regulatory framework was created in the first place. The story of why banks dump assets every December 31st doesn't begin in a trading room. It begins in a conference room in Switzerland in the aftermath of the worst financial crisis the modern world had seen. The year was 2008. Lehman Brothers had collapsed. Bear Stearns had been sold for pennies on the dollar. AIG required a government bailout of over $100 billion. The global financial system was on the edge of complete failure. Governments around the world were forced to rescue banks using taxpayer money because these institutions were considered too important to let die. The public was furious. Politicians demanded answers. And regulators were tasked with creating a system that would prevent this from ever happening again. Their solution was Basel III. Basel III is a set of international banking regulations developed by the Basel Committee on Banking Supervision. The committee consists of central bankers and regulatory authorities from the world's major economies. Their goal was straightforward: make the banking system more stable by forcing banks to hold more capital and take fewer risks. On paper, the logic made perfect sense. If banks had more capital reserves, they could absorb losses without collapsing. If they held safer assets, they would be less likely to fail during market downturns. The regulations were designed to create a financial system that could withstand shocks. But implementing these rules created something unexpected. The regulators needed a way to measure which banks posed the greatest risk to the global system. They couldn't treat a small regional bank the same way they treated JP Morgan Chase or HSBC, so they created a classification system. Banks that were large enough, interconnected enough, and complex enough to threaten the entire financial system if they failed were designated as global systemically important banks, G-SIBs. These banks would face stricter rules than everyone else. They would need to hold more capital. They would be subject to more frequent examinations. And most importantly, they would be scored on a scale that measured their systemic importance. The score is calculated using 5 categories. The first is size. How large is the bank's total exposure? The second is interconnectedness. How deeply is this bank linked to other financial institutions? The third is complexity. How complicated are the bank's operations and structure? The fourth is cross-jurisdictional activity. How much business does the bank conduct across international borders? The fifth is substitutability. How difficult would it be to replace this bank's services if it disappeared? Each category is measured, weighted, and combined into a final score. That score determines which bucket the bank falls into. There are 5 buckets, each requiring progressively higher capital surcharges. A bank in bucket 1 might need to hold an extra 1% of capital. A bank in bucket 5 might need an extra 3.5%. That difference might sound small, but when you're managing trillions of dollars in assets, a few percentage points translate into tens of billions of dollars that must be held in reserve instead of being deployed for profit. And here's the critical detail. The score is calculated based on the bank's balance sheet on a specific date, December 31st. The regulators chose year-end because it provided a clean, consistent measurement point. Every bank globally closes its books on December 31st. It made sense from an administrative perspective, but it created an enormous loophole. If the score is only measured once per year on a single day, then banks only need to look good on that one day. The other 364 days of the year, they can operate differently. As long as their balance sheet looks clean on December 31st at midnight, they can optimize their positioning for the regulatory snapshot. This wasn't an oversight. The regulators knew this would happen. But they accepted it as a necessary trade-off. Continuous monitoring of every major bank's balance sheet in real time would be administratively impossible. So they chose a single annual measurement date. The banks naturally adapted their behavior accordingly. Over the years since Basel III was implemented, this year-end adjustment has become more pronounced. Banks have refined their strategies. They know exactly which assets increase their G-SIB score and which ones don't. They know how much capital they can save by temporarily reducing their exposure to volatile assets. And they know that if they coordinate this adjustment with the end of the fiscal year, they can minimize the disruption to their actual business operations. What regulators designed as a safety mechanism has become a predictable market event. Every December 31st, the same pattern repeats. Assets are sold, cash is accumulated, balance sheets are cleaned, and the markets experience volatility that has nothing to do with economic fundamentals and everything to do with regulatory compliance. There's a moment every December 31st when the financial world splits into 2 groups. The first group consists of ordinary investors watching their portfolios turn red and wondering what went wrong. The second group consists of people who understand that nothing went wrong at all. They're watching a machine execute its programming. To understand what happens to specific assets during this regulatory event, one must first understand the currency at the center of it all, the US dollar. When banks need to improve their balance sheets for the G-SIB assessment, they don't just sell assets randomly, they sell everything and convert it into one specific thing, dollars. Not euros, not yen, not gold, dollars. The reason is embedded in how the global financial system operates. Most international banking transactions are settled in dollars. Most commodities are priced in dollars. Most debt obligations between major institutions are denominated in dollars. When regulators assess a bank's liquidity and stability, they primarily measure dollar holdings. A bank with $50 billion in cash looks fundamentally more stable than a bank with $50 billion worth of other assets. This creates intense dollar demand on December 31st. 30 major banks around the world, all simultaneously trying to increase their dollar positions, create a temporary shortage. The demand spike pushes the dollar index upward. And when the dollar strengthens, everything priced in dollars becomes more expensive for foreign buyers and less attractive to hold. This is where precious metals enter the picture. Gold and silver are priced in dollars per ounce. When the dollar strengthens, the price of gold and silver mechanically decreases. But there's another layer to the story. Banks don't just hold physical gold and silver. They hold derivatives, futures contracts, and paper claims on precious metals. These positions carry risk weight in the G-SIB calculation. A bank holding gold futures is seen as taking on price risk. If gold's value fluctuates, the bank's balance sheet fluctuates with it. Regulators view this as instability, so banks close these positions before December 31st. They sell their futures contracts. They unwind their derivative exposure, and in doing so, they push prices downward. The selling pressure is amplified by market structure. The precious metals markets are smaller and less liquid than equity or bond markets. When large institutional orders hit these markets on a holiday-shortened trading day, the price impact is magnified. A sell order that might move gold by 1% on a normal trading day can move it by 3% when liquidity is thin. Silver, being an even smaller market than gold, experiences the most violent swings. Traders have a saying, when gold catches a cold, silver catches pneumonia. The correlation between the two metals is strong, but silver's lower liquidity means its price movements are more extreme in both directions. Then there are equities. Stock portfolios are viewed by regulators as volatile assets. A bank holding significant equity positions shows higher risk in the G-SIB assessment. So banks reduce their stock holdings approaching year-end. They don't liquidate everything, but they trim positions, especially in more volatile sectors like technology and small-cap stocks. The effect on major indices can be subtle but measurable. The final trading sessions of December often show weakness that reverses in early January. Professional traders call this the January effect, though its causes are debated. Part of that effect is simply the unwinding of December's regulatory-driven selling. Bonds present a more complex picture. Government bonds, particularly U.S. Treasuries, are considered safe assets. They carry lower risk weight than stocks or commodities. So one might expect banks to increase their bond holdings before year-end. But the reality is more nuanced. Banks need cash, not bonds. While bonds are safer than stocks, they're not as liquid as dollars. So even some bond positions get sold in the final days of December. This creates unusual dynamics in fixed income markets. Treasury yields can fluctuate more than expected as banks adjust their positions. Corporate bonds, especially lower-rated ones, face selling pressure as banks move toward the safest possible portfolio composition. And then there's the newest asset class, cryptocurrency. Digital assets occupy a strange position in the regulatory framework. They're not yet fully integrated into G-SIB calculations, but banks with crypto exposure face scrutiny. Most major banks have minimal direct cryptocurrency holdings, but some have exposure through derivatives or custody services. Those with exposure tend to reduce it before year-end, adding to selling pressure in crypto markets during the final weeks of December. The pattern across all these assets is identical. Selling intensifies as December 31st approaches. Prices drop not because fundamentals have changed, but because institutions are optimizing for a regulatory snapshot. And the moment that snapshot is taken, the pressure reverses. January 2nd arrives. The banks no longer need to maintain artificially elevated cash positions. Capital begins flowing back into markets. Prices recover. The cycle completes. For those who understand this pattern, December 31st isn't a day of panic. It's a day of opportunity. But for those who don't, it's a trap that repeats every single year. There's an old principle in financial markets that most people learn too late. The market rewards those who understand what others are forced to do. December 31st is not a mystery. It's not insider information. The regulatory framework is public. The G-SIB assessment methodology is published openly. The bank's year-end behavior is documented in academic papers and financial research. Yet every year, the same pattern catches people off guard. The difference between being trapped and being prepared comes down to one thing: recognizing the distinction between forced selling and fundamental change. When an investor sees gold drop 5% in a single day, the natural instinct is to assume something has fundamentally changed. Perhaps there's news about inflation. Perhaps central banks are shifting policy. Perhaps demand has collapsed. The mind searches for a narrative that explains the price movement. But sometimes the explanation has nothing to do with the asset itself. Sometimes prices move because someone is required to sell, regardless of value. This is the essence of regulatory-driven volatility. It creates price movements that are disconnected from underlying fundamentals. And that disconnection creates opportunity for those positioned correctly. The pattern is remarkably consistent. In the final week of December, particularly on December 30th and 31st, selling pressure intensifies across multiple asset classes. Then, in the first week of January, particularly by January 5th or 6th, prices tend to recover. This recovery isn't guaranteed, but it occurs frequently enough that professional traders plan for it. They have a strategy. While others are panicking and selling into the decline, they're buying. They're absorbing the forced institutional selling. They know the banks will return to the market in January. They know the regulatory pressure will lift, and they position themselves to profit from the predictable rebound. But this strategy requires discipline. It requires cash reserves held specifically for these moments. It requires the emotional control to buy when everyone else is selling. And it requires the analytical framework to distinguish between a regulatory event and a genuine market crisis. Not every December sell-off is purely regulatory. Sometimes real economic problems coincide with year-end volatility. Sometimes the selling continues into January because fundamental conditions have deteriorated. The skill lies in reading the signals correctly. There are indicators to watch. If the decline is isolated to December 31st and trading volumes are unusually low, it's likely regulatory. If the decline extends across multiple weeks and volumes are high, something more fundamental is probably occurring. If gold and silver are falling while the dollar is spiking temporarily, it fits the regulatory pattern. If they're falling while economic data is collapsing, that's a different situation entirely. Sophisticated investors develop checklists. They monitor the dollar index. They track precious metals volume patterns. They watch for statements from major banks about balance sheet adjustments. They compare current year-end behavior to historical patterns. And they make decisions based on weight of evidence rather than emotion. For business owners, this phenomenon has practical implications beyond trading. Companies holding significant cash reserves need to understand that year-end is when liquidity becomes most valuable. Banks are competing for deposits. Interest rates on short-term instruments can spike briefly. A company with cash to deploy on December 31st might secure better terms than it could at any other time of year. Similarly, businesses that need financing should avoid year-end if possible. Banks are reducing their loan books, not expanding them. The worst time to seek credit is when lenders are trying to shrink their balance sheets for regulatory purposes. January offers better conditions as banks resume normal lending operations. The broader lesson extends beyond specific dates. Regulatory frameworks shape behavior. When regulations create incentives for certain actions, those actions become predictable. And predictability in markets is valuable. It allows for planning. It allows for positioning. It allows for strategy rather than reaction. This is why understanding the G-SIB trap matters. It's not about predicting the future. It's about understanding the present. It's about recognizing that some market movements are mechanical rather than meaningful. And it's about using that recognition to make better decisions. The banks will continue this behavior as long as the regulatory framework remains unchanged. Every December 31st will bring the same pattern. Assets will be sold, cash will be accumulated, balance sheets will be optimized, and markets will experience volatility that has nothing to do with economic reality. Those who understand this will see opportunity where others see chaos. They'll buy when the forced sellers are dumping. They'll sell when the buying returns in January. They'll profit from the predictable cycle while others are confused by it. But there's a final consideration. The existence of this pattern raises a deeper question about the financial system itself. When regulations designed to create stability instead create predictable instability, something has gone wrong. When the largest banks in the world coordinate their behavior around arbitrary dates, the system is revealing its fragility rather than its strength. The G-SIB trap isn't just a trading opportunity, it's a warning sign. It shows that regulatory compliance has become more important than market fundamentals. It shows that institutions optimize for snapshots rather than genuine stability. And it shows that the financial system operates on mechanisms most participants don't understand. For the informed observer, December 31st is a reminder. Markets are not purely driven by supply and demand. They're shaped by rules, incentives, and institutional behavior. Understanding those forces is just as important as understanding economics. If the trap exists, the question is whether you'll be caught in it or positioned to benefit from it.